Hey, this is Jeffrey with another edition of Stock Smart, March 24th, 2021 edition. Hope you're doing well. I want to talk first about Intel. Intel making a huge splash, announcing that they are building 2 new facilities to make semiconductors in the U.S., spending $20 billion. Plants will be located in Arizona, and it's a big deal. We talked about this being a major national security issue because we only make about 12% of the world's semiconductors. Once hailed as the leader, Intel now is falling behind a little bit. But this will give them some footing in this space again. And it'll also curb kind of this idea that the U.S. is falling behind here. And think about this from a national security issue. And I always think about worst case scenario. I think about a war, some kind of a global war. And all of our military installs and equipment, weaponry, they all require chips. Now, if we're only making 12% of the world's chips, that's not good enough if we go into some kind of war situation, and we're going to have a national security issue here. So this is great news. The shortage in chips is also, this is great news for that as well. I saw a recent article from the Volvo CEO, because cars are being hit heavily because every component in a vehicle requires a chip nowadays, especially in these new EV cars, or the autonomous cars, of course, have tons of chips. This is a great shortage. The CEO of Volvo, in an interview, mentioned that the needs are satisfied for about 1 week out. That is terrible. 1 week out? Are you kidding? A massive production company like Volvo? 1 week out, they're secure about their chips? Now, that's not great. That's really bad news, in fact. VIX is down slightly. Again, we're nearly neutral on the S&P 500 oscillator, so it's time to maybe start dipping a toe in and reestablishing positions because we're not oversold, we're neutral. But that's usually a good buying time. And we're heading in, we're another couple weeks away from earnings. We're going to start bank earnings again in 2 or 3 weeks. And those are going to disappoint because the banks are so overdone. You can see the move already. But the banks are way overdone. They've had a massive move in a short period of time. 10-year note up a little bit to 1.64. Again, watching the creep with inflation, thinking that this 10-year note probably gets to around 2% by the summer. We're going to have a big announcement on the show coming in the next couple weeks. And I am really excited about it, and I think that the listeners will be excited about it. It's going to bring a whole load of new topics in. I'm going to talk a little bit about sports more. Sports and stocks, not a bad combination. But that's coming next couple of weeks when I can make the announcement official. I'm really excited about it. Let's take a look at a stock. We're going to do the marketing language here. We engage in the provision of digital marketing and media solutions. We operate through the following segments: digital media, digital experience, and publishing. The digital media segment offers creative cloud services, which allow members to download and install the latest versions of products. So who are we? Adobe, ADB, down about 1.6% today. The stock really has been sideways for about a year, or at least 9 months. This is a great company. They are in everything. They're in online retail. They're in creative. Everything you need to do to be online for your store, Adobe is in it. The most expensive software that you needed for a design business was Adobe purchased. And Adobe did a great thing. They were one of the first ones really to start this SAS model because the Adobe Photoshop, which was the anchor or the flagship product for them for years, and then they had PDF and a bunch of other things. And now they have Illustrator and tons of other things in digital applications as well, and their cloud services, of course. But if you were in the design agency, everyone had Adobe, and it was the Photoshop, and it was so expensive. But now you can get all those products online. You pay a subscription model, you get it updated all the time, and it's a great product. And their suite of products is really incredible, but that's not all they do. They have this whole online platform that assists, online retailers in building things and getting data that they need. They have amazing analytics data too, by the way. We like this stock, but stocks of this type are out of favor. The big growth high-tech stocks, they're out of favor right now. And Adobe is just like all those others. Down today, dip a toe if you don't, maybe for the future. It's a great company, great bottom line, great products. It's not going anywhere, but it's just a stock out of favor right now. But the reason I wanted to bring up Adobe is because they have a great bit of data that they release. It's their own data, and it's called the Adobe Digital Economy Index, and they get these analytics from the online retailers that work with them, and it's pretty amazing. And Amazon has some of this data. They don't release as much, but they have some of this data as well. But the Digital Economy Index, essentially, it's powered by Adobe's analytics program. that analyzes 1 trillion visits to retail stores and 100 million SKUs or SKUs. So it measures transactions from 7 out of the top 10 US airlines. That's a lot of good data, especially now when we're looking at travel data. And then they do a companion research study based on, about 1,000 US consumers 18 years or older. And they did this research in between late February and early March. But I'll talk about some different things that they got out of the report, which is really interesting, especially when you're looking at stocks. And this is kind of a funny one to start with, because I always say I used to go to, in the last year, I work for myself. So I can set my own schedule. It's great. I'm very lucky. I know it. But I would go to Home Depot on like a Wednesday afternoon or Wednesday morning. It's 11 or 12 o'clock. And that place was packed in the last year. I'm thinking, who do these people work for? But this is the data that Adobe produced. Consumers are shopping more, and they're shopping more during work hours. Oh, that's great. And I'll tell you, when people go back to the workplace, you're going to see a host of sites that are blocked. Their network operations people are just going to block sites. They're going to do it. This has been done for years. And it really started, honestly, with the porn industry. But they used to block these porn sites because their people would be like watching it during working hours. I don't know what they were doing with that during working hours. I don't want to talk about it. But they're going to block sites. They're going to block stock trading sites. You'll see it, Robinhood. They're going to block these sites when people go back in the office. And they're going to block retail sites. They just will. That's the way it goes. But they're spending an extra $1.2 billion during work hours. So that's no shock. People are probably less productive. I always talk about this. I think about it as the bell curve. I think you get a lot of people on the one end who are working their ass off at home and they really love working at home. You get the other people who are slacking. Then you get everybody else who's probably just okay. And that's what I think about working at home. So in 2020, we had a big move in home improvement and apparel got killed. It makes sense. I mean, how many pairs of sweatpants do you have? That's what you wore in 2020. Everybody just wore sweatpants or hoodies. I mean, I wear hoodies and sweats. Leisure wear. That's what everyone's, that athleisure category. That's big. That's why Lululemon's done so well. But people spent a lot of their money online on home improvement. Home improvement saw 60% year-over-year growth. And apparel lagged. But now we're seeing move into apparel. So if you're interested in online retail and online apparel, that's actually picking up again as people are starting to go out again. They want to dress up. People haven't bought a lot of apparel or dressy clothes in a long time. So it's an industry or an area where you can see some growth. Online groceries, of course, they've gone way up. Online groceries have surged to levels 350% more than pre-pandemic levels. And so that's a big deal. Sporting goods got a boost. But an area where like a stock that you want to take a look at, Etsy, which has moved so much, is that people have gotten involved in like puzzles and games and online crafts. And that's really impacted Etsy in such a good way. Now, do I think that Etsy is a great stock in the next year? I don't think it is going to be anywhere near what it's done because people are going to get out and they're going to do different things. They're not going to be worried about things they can do in their homes. It is still a good company, don't get me wrong. And they were great at shifting to the needs of their consumers when they started producing their creative versions of masks, and they made millions of dollars on that. Really clever, really good management team. So Etsy, ETSY. Now here's a new thing that we got, and this makes a lot of sense. Because of the pandemic, 9% of consumers reported that they never purchased an online item prior to the pandemic. And so they're new consumers online. And they agree that because of the pandemic, it forced them to buy certain things online. So that's really interesting. So you have this whole growth of about 9 or 10% of people who never purchased anything online who are now online shopping. So that's a big trend. And another big trend and you'll see a lot of these companies are going public. And there was one that just went public about 3 months ago called Affirm. I actually used them when I did a home remodel. I bought something on Affirm because it was like a buy now, pay later deal. And the interest isn't really in the product. They don't really charge you interest. What they do is they create deals essentially with the developer of the product. So like a big one that they started with was with Peloton. So if you wanted to buy the Peloton for $2,000, you would go and you could pay for it with Affirm. And what Affirm does is they create a deal with Peloton to get paid by Peloton. And they don't really have to charge you interest. They can just make the money they make being the intermediary between the cost of the good and what they charge you for, and then they're responsible for collecting. But Affirm just went public, interesting company. But this is the trend: buy now, pay later, seen growth of 215% year over year. So keep an eye out for some of these companies. Other ones that I know of are Klarna. PayPal has an offering like this as well, getting into that. One thing, this is another thing out of the report, is inflation. And purchasing power is really what we talk about. Reduced purchasing power is what we talk about with inflation. So as things become more expensive, your dollar becomes worth less. Worthless. Not worthless, but worth less. And so things that have gone up in 2019 and 2020, electronics went down 10%, groceries went down about 1%, computers went down about 14%, and home and garden supplies went down about 9%. Now, 2020, 2021, we see a big surge in grocery prices, up 4.2%. Home and garden, up 4%. So we're seeing inflation, and that's going to reduce your purchasing power. So keep an eye on that, and we keep talking about it here, and that's what's going on with the selling of the bonds. Bonds are being sold, yields are going up, bond prices going down. It's inflation. And prices now, because of all the shift online, and this is just a survey, so the way that consumers feel about pricing. I could tell you right now, the CPI that's being done, I don't think it's being calculated properly because they're not going out to stores, to the vendors specifically, and getting the data. They're doing it online and they're doing it over the phone, which I do not think is as effective as being in person. I think these CPI numbers are going to bump and they're going to give everyone a big headache in the next few months when we start seeing the real numbers get out, when people start doing when they start doing the interviews to get the CPI data in person again. But consumers feel like prices are going up. I ask people all the time, do you think things are more expensive? They're like, yeah, it's crazy, especially gas. I mean, gas went up, it's like 17% in the last 3 months. The national average for gas is going to be $3. We pay way more in California because they have a tax on everything in California. They think it's funny. They just like, well, let's tax that. But we have so many environmental taxes in California that our gas is usually the most expensive. When I go to Arizona, I go see my kids and I'll drive to Arizona. I wait till I get right over the border and I buy that Arizona gas because it's cheaper. But here's how consumers feel about prices. Groceries, 51% of people have gone up the past month. That's how they feel about it. Medical equipment and supplies, 39% feel they have gone up. Media and entertainment, 35%. And sporting goods, 35%. That's how consumers feel. That's not the percent that they've gone up, but consumers feel those things have gone up a lot. And what's happening is all this purchasing online, we're getting a lack of what they call stock out. And in July, this started in July, where we saw 3 times as many products that were out of stock as they did, pre-pandemic. So we're lagging in the goods being provided. And now we saw this. We talked about the shipping containers. Port-to-port shipping containers, they're paying, if you're a shipper, so if you're an import-export, you're paying 3x more to get your product from one place to another. So that's incredible. That's going to flow right down the line. So an extra $183 billion was spent online. That's up to about $850 billion. And we're supposed to go over $1 trillion now in online spending in the coming year. And so if you're interested in a stock or an ETF that might do well with that, it's the ONLN, which is the online retail ETF. And that's one you might want to take a look at there. So let's get to a question.
The average investor.
All right, so I got a question, and this is common. A lot of people, I've seen a couple of people out recently, and they're like, what's going on? My portfolio is getting killed. And this is a question from Mike. Mike says, I'm really frustrated lately because my portfolio lost 12 to 15% with the recent rout of the NASDAQ. I feel like I want to get out of the market. And this is a common feeling. What happens is just when you feel like you should get out, that's when you should stay in. That's usually what happens with investing. And so, Mike, I would say just remember, stay the course, stay invested. If you're over leveraged, not leveraged, but if you have too much of a supply of the NASDAQ stocks, maybe diversify a little bit, get some balance, reduce some risk so you get to a comfort level again where you want to invest. But again, generally when the market's getting routed in a certain way, and we're seeing these high growth companies fall out of favor right now, you need to stay invested because these things, they change and they evolve really quickly. And you're generally not able to time the market. And I would say, here you go, and don't rip me off on this shirt if it doesn't exist already, but just stay calm and invest on. Mine would say something like, stay calm and don't overthink it. That's me. But you should just stay calm and invest on. And I wanted to give you some comfort because the greatest investor of our time has made numerous mistakes. But Buffett greatest investor of our day, has made numerous mistakes. Talk about how he bought in U.S. Airways, which was a dog. He bought originally the company that his company is called, which is a big success, Berkshire Hathaway, but the original Berkshire Hathaway was a textile company. And Buffett got pissed off, to put it nicely, that they tried to screw him, essentially, Berkshire Hathaway. And so he started buying the company and took control of it. He fired the management team. He tried to keep the business running for about 20 years. Well, his spiteful actions cost him about $200 billion. So you're not alone. You're not alone, Mike. Buffett's done this to himself as well. Buffett also didn't invest in Amazon because he doesn't invest in those types of companies. He's a value investor, which, I get it. If you read the Ben Graham book on investing, that's where Buffett's style comes from, was the value investing, looking for stocks that are not appreciated, undervalued. We're seeing a huge move in value investing right now. But Buffett never invested in companies like Amazon or Google. That would have to be considered a miss. He's taken on a lot of debt from his energy, future holdings. He missed an opportunity to buy an NBC station in Dallas-Fort Worth that cost him a lot of money. Bought a company called General Reinsurance and didn't perform due diligence, which you would think a guy like Buffett would do. The point is keep investing. If you have to diversify, get out a lot of risk, do it. Hey, and keep the questions coming, guys. And we'll see you again next time on Stock Smart.